I'm sure there are a lot of retail investors waiting for these big name tech unicorns to come public and wondering whether they get involved. What'll be the driving thesis here, especially when so many of these companies aren't profitable? Is it going to be profit or is it going to be growth?
It's going to be growth, but it's really going to be the overall market for sure. The IPO market follows the stock market. So as long as things are okay there, we're going to be fine, but very volatile. So look at the companies, look at the sales, look at profits, but the market is the big driver for sure.
Are you saying that with these companies finally going public that we could be seeing a market top right now?
Well, I think, look, let's be honest. I mean, if you're buying now, you're not buying at the bottom of the market for sure. We're 9 years into economic expansion. Prices are going up. You're not going to get great deals, but I will say this. It's not super crazy land. If you look at Lyft, you look at some of these companies, they're about 10 times trailing sales in valuation. So it's not nuts. And it was a couple of years ago, actually. So it's a paradox a little bit.
Mike, there seems to be this brewing debate right now that with so many big name companies getting ready to go public that are going to be valued in the multi-billions of dollars, that could suck some of the oxygen out of the room, so to speak, in terms of where the investment dollars are flowing. How should investors think about it?
It's definitely unique that we have this number of what you would call blue chip IPOs, right? Multi-billion-dollar valuations raising more than $1 billion, kind of more or less at once. I don't think it's an outright swamping the market with new supply type story. In other words, there's plenty of money out there to receive these deals. But I do think you have to have an appetite for a certain kind of growth investment, for a certain type of business model. And that's what I think is going to be tested here. Look, 5 years ago, Alibaba got done. It was much bigger than any of these deals is likely to be, and that was a market that was a good deal lower, right? So you can get it done, but I think the public market rendering its judgment on this type of company like Lyft and Uber, and even some of the delivery companies where it's not just a software business with software economics. It's hard stuff mediating between real world people driving stuff around and customers who want a great deal. I mean, that's the question to me is, are they going to ratify these valuations?
Brian, how closely should we watch the difference in reception between a Lyft and Uber and, say, a Pinterest? Just taking a look at Pinterest as one. This company seems to have been more disciplined in the way it's grown, to put a fine point on it, than some others. And at this point in the year, I'm not sure we've seen investors have a different reception for discipline versus not.
Yeah, I think it's a good point. To me, the difference between Uber and Lyft is six of one, half dozen of another. I think they're about the same on valuation metrics. But I want to go back to a point that Mike mentioned. I got to get the dead cat out in the room right now. I have to say this. I'm worried we won't cover one thing, and it's this whole idea of how these guys are structuring their the stock, where in the case of Lyft and Pinterest, these guys are coming in and saying, look, I get one share, or, me as the retail investor, you get one share, one vote. But the executive team is getting 20 votes for every share. So I just want to mention that. That's bothering me a little bit in corporate governance. I think tech guys like me, entrepreneurs like me, we think we can kind of defy basic common sense sometimes and even fairness. So I do want to get that out. It's not a huge deal on valuation, but I'm worried that people are following the Facebook model, which is, one for me, two for you. It doesn't make sense to me. And I'm a little worried about how that drives the tech sector going forward, even though it seems like a nit.
Well, I mean, it worked out well for Facebook shareholders ultimately, Brian, but not so much for Snap. And that's one that I wanted to bring up because that's sort of a recent flashy IPO, new business, advertising revenue, competing with the Facebooks and Googles of the world. I mean, are there parallels with a Pinterest or even with a Lyft or an Uber that investors should be aware of after getting burned, many of them, by Snap?
Yeah, absolutely great point. Terrific. We covered Snap a lot, as you know. They were super overvalued. A lot of growth, no profitability, poor net margin. So does gravity make sense in the tech sector? Does it actually work? Yes. In other words, if you've got good sales, you got a good valuation, you got profitability, you have cash flow, you're not going to be immune from a downturn, but you're going to be in better shape. And Snap, and even Twitter, by the way, even though they've done great, if you recall, they were literally, I think, like 44 times trailing sales on their valuation. It took a long, long time for that company to come around. So as an investor, if you invest in something that's overvalued, you're going to wait a long time, especially now that we're at the top of the market. So that's my fear.
I mean, one thing to keep in mind is one reason there's going to be a reception for these among fund managers is that none of these stocks are in an index. And this is the way to essentially try to outperform. You have brand new names of big market cap.